So you want some capital appreciation and some passive dividend income. Well, look no further than the iShares Core High Dividend ETF, ticker symbol HDV. Welcome back, everybody. I like to do periodic reviews of ETFs that I find very interesting, and I actually like to give an unbiased view of these ETFs, which is sorely lacking on YouTube. On this platform, everybody promotes everything and just claims that it's an amazing investment. I'm going to give you an unbiased review of this ETF and tell you my honest thoughts about it. So first of all, what is this ETF all about? Well, if you pull up a fact sheet, it's an iShares ETF by BlackRock. Have you heard of them? They're basically taking over the world. This ETF seeks to track the investment results of an index composed of relatively high dividend-paying U.S. equities. Now, let's stop right there on that sentence. First of all, would you say this is a concentrated ETF? Would you say this is an actively managed ETF? Would you say this is a narrowly focused ETF? I would say yes. First of all, there's more than just U.S. stocks out there in the world. I don't know if you knew this, but roughly 40% of the total market capitalization of all publicly traded stocks in the world is foreign or international stocks. The remaining 60% are U.S. stocks. On top of that, there are many stocks that do not pay dividends. I'll give you one stock that you may have heard of, Berkshire Hathaway. That's run by Warren Buffett and Charlie Munger. Have you heard of them? That's right, Berkshire Hathaway does not pay a dividend. So when you buy an ETF like this, number one, you're excluding thousands of stocks outside of the United States, and then you're excluding any stock that does not pay a dividend right off the bat. And while you may think a dividend is the end-all be-all, I've made videos about dividends. You have to remember, some stocks that are that represent amazing companies that can massively outperform the market don't pay a dividend at all. And by excluding those companies, you're potentially missing out on gains, extraordinary gains from those companies. So those are the two things right off the bat that I notice. The third thing I notice is that it claims it's an index, right? And basically an index is just whatever you want. You can make an index out of anything. You can make an index out of paint stocks. You can make an index out of automotive stocks. You can make an index out of anything you want. But does that truly represent the essence of indexing? I don't believe it does. I believe the true essence of indexing is sitting there and saying you don't know which stocks are going to outperform because you believe the vast majority of all the known information of those companies is already priced into those stocks. So instead of trying to pick and choose and factor in and factor out, you decide to buy a total market index. Because when you do that, you're not picking winners or losers, you're letting the market decide. This ETF is picking winners and losers. Let's read a little bit more. Exposure to established high-quality U.S. companies. Access to 75, just 75, dividend-paying domestic stocks that have been screened for financial health. Now, when you see the word screened, what does that tell you? That tells you there's some kind of human active management involved there. And use at the core of your portfolio to seek income. Okay, so we've talked about all three of these, but I also want to hone in on 75 stocks. Now, you may think 75 stocks is diversified. Is it? Well, what are the weightings of those stocks? If the portfolio was divided evenly between all 75 stocks, okay, as a reasonable person, I would say that's diversified. But what if 99% of the portfolio was in one stock, and then the other 74 stocks comprise the remaining 1% of the portfolio? Would that be diversified? That's something you need to think of, which we're going to look at in a second. So this ETF has been around for a good, 12 years? So it has a pretty good track record. So that's at least one thing that's good about this. It has an insanely low expense ratio. That is incredibly low. Now, if you wanted to buy VTI, the Vanguard Total U.S. Stock Market Index, it would be a 0.03% expense ratio, which isn't that much cheaper. Okay, so that's a pretty good expense ratio. It has an SEC yield of 4.2%, which is basically like an annualized yield. You're not getting that monthly. That's basically an annualized yield of what you could expect to get in the future theoretically, if everything continues as it was going in the past. It's got 75 holdings and $13 billion of net assets. So overall, it's a pretty hefty fund. Now, here's another concerning thing that I see. Top holdings. We have ExxonMobil, 9%. Now, this is, in my opinion, pretty decently concentrated. In my personal opinion, you should have no more than 5% of your portfolio in any individual stock. And you should definitely not have more than 5% in one individual stock. Now, when you look at ExxonMobil, that's 9.28%. That's a pretty concentrated, in my humble opinion. So even though you're investing through an index, which you may think is diversified, you're still putting 10% of your investment, roughly 9-10% of your investment in one company. The next one is Verizon. Then we have Chevron. Then we have, a couple other companies. All of these are very familiar. I'm sure most of you recognize these companies. But look at these two, ExxonMobil and Chevron. Both of these companies are oil companies. They make oil and they sell it, okay? Oil has massively outperformed recently because oil prices have gone through the roof. Oil companies are making record profits. What do you think could potentially happen if oil starts to go down again? Well, all those record earnings and dividends and profits of the oil companies may go down, and that may negatively affect your portfolio. And out of the top three, two of those in this ETF, comprising roughly 15% of the total portfolio, is in, you guessed it, oil stocks. So that's something to keep in mind. Okay, but overall, it's had pretty good performance. But one thing you need to keep in mind, past performance does not guarantee future performance. Not in the slightest. And the way I look at the world, and I'm not saying this is 100% accurate, but generally when I see past performance, when I see massive past outperformance, generally that's a red flag to me because it tells me there must have been some kind of market conditions, some kind of condition that enabled these specific investments to do well in the past. Could it potentially revert to the mean in the future? Now, just because something did well in the past doesn't mean that it's not going to continue to do well in the future. I want to be very clear about that. But it's also a sign that there may be trouble ahead because sometimes good things don't last forever. People get attracted to good returns. That's how people invest. They see stuff that went up a lot. They tend to buy stuff that went up a lot. And that's kind of a self-perpetuating cycle that leads to potential bubbles. That's just something to keep in mind, okay? Now, here's another thing that I don't really like about this ETF. So I looked and I pulled up the prospectus, which is like, the information about the fund. And I noticed something very interesting. Now, for an ETF, this has a very unusually high portfolio turnover rate. Turnover is what percentage of the portfolio's underlying assets are swapped out throughout the year. So when you look at this quote right here that I've highlighted, during the most recent fiscal year, the fund's portfolio turnover rate was 74% of the average value of its portfolio. Think about all the hidden costs that are associated with this fund buying and selling and turning and selling this stock and buying this stock and flipping out this and flipping in that. That's an incredibly high turnover. You want low turnover. You don't want stuff to be flopped in and out of a portfolio because every time you buy or sell something, you're paying transaction costs, commissions, etc., which could negatively impact your performance. That's a very concerning number. It's not the end of the world, but that's higher than I would expect from an index. Now, when you look at this, they screened for certain criteria. Okay, they screen for economic moat, distance to default, Morningstar uncertainty rating, and qualified dividend income. Now, you may, on the surface, say, okay, all these things are great, and they are. I mean, obviously, you want a company that has a moat. You want a company that is far away from defaulting. You want Morningstar uncertainty ratings. I guess I don't even know why that would matter. And then you have qualified dividend income. Now, qualified dividend income is good because dividends are taxed in two different ways. They're either qualified and they're taxed at preferential rates, or they're unqualified and they're taxed at your highest marginal tax bracket. So you want qualified dividend income, theoretically. But when you're looking at this, you say, okay, I get it. These things are great. Doesn't everybody else already know that these stocks have good moats, that they're far from defaulting, that they have qualified dividend income? The people that are screening for this ETF, they're just one of thousands, millions of market participants that know the same information. So what kind of advantage are you getting by saying, okay, I'm going to screen companies, I'm only going to buy companies that have healthy balance sheets, when everybody else can simply just pull up the same balance sheets that you're looking at and identify the same things that you think in all your infinite wisdom are pretty obvious to you. So of course that basically eliminates the advantage. So overall, this ETF you need to understand the risk of this ETF. Number one, you're concentrated in one country. Number two, you're concentrated only in high dividend paying stocks. What about medium dividend paying stocks? What about low dividend paying stocks? What about no dividend paying stocks? On top of that, you're only in 75 companies. And while you may think that's diversified, the top 15% are in 2 oil companies that have outperformed recently. Okay? This fund also has pretty decently high turnover. Those are all things you need to consider when you're potentially thinking about investing in something like this. You have to do your research, okay? You can't just buy stuff because it says high yield and because historical returns are good, because honestly, to me, that's a negative indicator. That's something that's concerning to me. So overall, that's my opinion. I'm not buying this. I don't want to pay a bunch of taxes on dividend distributions. I prefer total return investing, where it's a factor of capital appreciation and dividend yield, instead of focusing and narrowing my investment pool to a very few amount of stocks, very few amount of companies that only do a certain thing that may not necessarily be a good thing. Let me know your thoughts in the comments below. Don't get angry. I think this is a pretty unbiased review, and I'll talk to you later.